Okay, so now on to in-class problem 7.3. This one's conceptually similar to 7.2. However, we've just got a different growth pattern and different number of years. In early 2019, an investor wants to determine the maximum price they're willing to pay for a share that recently paid a dividend of $1.25 at the end of 2018, or basically at time zero. Now, the investor believes that the earnings will be 8% for each of the next 2 years, 12% for the 3 years following, and then level off at 6% indefinitely. And the rate of return we want is 7.5%. So we are at the end of 2018 or the beginning of 2019. The last dividend that was paid was $1.25. And then what we want actually is what the dividend is going to be at the end of the first year. So we're going to take that and multiply by 1.08 because the dividend grows for the first 2 years at 8%. This will give you 1.35, so that's the end of the first year. And then we'll multiply that by 1.08 again to give you 1.458 at basically the end of year 2. So this is D1, D2. Now, D3 is going to take D2 multiplied times 1.12, and that's going to give you a value of 163. We multiply that again by 1.12 to give you a value for D4 of 1.8289. And then once more to get D5 times 1.12 is 2.0484. So that's the value at D5. Then what happens is this grows perpetually. So then if we multiply this by 1.06, this will give us our dividend at D6, which will then continue perpetually. So it's 2.1713 D6, which grows perpetually. So what's going to happen is we have to discount this to be the price of the share at P5 using the same formula that we had before, the dividend divided by 1 minus the growth rate. In this case, P5 is equal to D6 divided by R minus G. The dividend at D6 is 2.1713 divided by 0.075 minus 0.06. If you look in the problem, 7.5 is R and G is the growth rate. This will give us a value of the share with a perpetual growing dividend of 144.7533. So this would then be added to the fifth year, and we would add these together. So we would add the 144.75 plus the 204.84 to give us a total of 146.80. All of these would have to be discounted back to time zero individually, but that's a lot of work. And now that we know how to use your cash flow function, we're going to basically discount them all together using the cash flows. You can practice your calculator prowess by calculating the present value of lump sums on your own, but we'll jump right in and take each of these values and put them into our cash flow function in our calculator. So here we are, cash flow. We're going to second function clear everything, and I see that there's nothing in there. Remember that your first cash flow is 0 because this is not an offsetting NPV type of problem. We're using the cash flow function in the calculator. We'll go down to cash flow 1, where we determined already that that first cash flow is $1.35, enter for 1 period. Cash flow 2, 1.458, enter for 1 period. Cash flow 3, 1.633, enter for 1 period. Cash flow 4, 1.8289, enter for 1 period. And cash flow 5 is the 146, which is the sum of the dividend in the fifth year plus the value of the share with the perpetual growing dividend. So we'll enter that, 146.80, 1 period. And always a good idea to scroll through your list again. So cash flow 0, $1.35, 1, 145 for 11633, 18289, and then 146.80. We'll go NPV. We want 7.5% as the interest rate now, so we'll enter that, scroll down, and we will compute the NPV to be 107.4563, 147.45, 147.46. Adding all those together will give you a total value of P0 of $107.45 due to some rounding. And that is how to use your cash flow calculator with two different, this one had 3 different growth rates, 8%, 12%, and then perpetually at 6. So I hope you found this useful.